Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Good night. Welcome to the Australian Property Podcast, our weekly 2 cents segment with me, Pete Wargent from Alan Wargent Property Buyers and Chris Bates from the Flint Group. Chris, how's it going?
Things are doing very well, Pete. Got a couple of kids sick home today, which isn't great. Both woke up with some fevers. But other than that, just the parent work juggle. Things have been going quite well. It's back from Bali on almost 2 weeks ago now, which feels like a distant memory. So, looking forward to the second half of the year. It's actually 10 years in business this week. So it's having a little bit of a celebration this week. And I think my wife's set me up to do some skydiving up in Newcastle. So fingers crossed we get some good weather. And how have you been down there?
You're a braver man than me. I think I would give the skydiving a miss, but congrats on the 10 years. Yeah, it's come around quick, hasn't it? I remember the early days of the broking, and you did a bit more sort of in the coaching side of things early on and financial advisory type stuff, and now more mortgage broking and lending specialist. So congrats. And the business seems to go from strength to strength. So, good to see. Well, what have I been doing? Lots of, chatting to a lot of people about property strategy, really, over the past week or so. General thinking seems to be out there that Melbourne's maybe offering a bit more value now compared to some of the other capital cities. So the sentiment's maybe swinging back around in that direction. I think, obviously, over the past year or two, Adelaide and Perth and Brisbane have been more favoured, I suppose, and now people are starting to think maybe a bit contrarian, I suppose, and maybe Melbourne's got some better days ahead. So that's been taking up a bit of my time, and that's kind of been my week, really. Nothing, certainly nothing as exciting as skydiving for me. So and there's been stacks of stuff in the news, actually, just on the day of recording. We're just coming off the back of a whole dump of data, so plenty to talk through this week. Actually, before we get into the big three stories, so this is kind of what's been in the news just over the past 24 hours or so. So we had speeches from the Reserve Bank of Australia, speech from the regulators APRA. Then we got the monthly inflation data, which was hotter than expected. That's just the monthly inflation gauge for May. But it's just funny, actually, because when you look at the numbers, inflation was actually negative. Headline inflation was negative in May, but year on year, because we had a sort of a very significant negative reading dropping off from a year ago, inflation was back up to 4%, and the trimmed mean figures also accelerated a bit. Electricity prices have been hot and rents have been hot. So looking forward, we've got 4 much stronger readings to drop off the monthly figures: June, July, August, September. By that stage, we'll probably be back down to a 3% figure or thereabouts on that gauge. But I guess what all of this means is that August is now going to be a live decision for the Reserve Bank, which always gets people excited. And the quarterly inflation figures will be the key for that, which are released at the end of the month. So it's getting a lot of airtime and a lot of excitement around the traps.
Yeah, I mean, what's your take, Pete, on this inflation story? I mean, you're over in the UK at the moment, I believe, and the inflation there has really got under control. I mean, what's holding it back in Australia, do you think? And do you think we should be reading too much in this, monthly data? I mean, you can see the news outlets have gone absolutely wild on it today. And, the likelihood of a rate increase is still pretty low, but, everyone's now thinking that. And, like it has happened, probably, up from 0.5 up to, 4.35. So it's happened a lot of times now, these rate increases. Everyone talks about property doomsday, but my opinion on, when rates go up and higher inflation, all you're really going to do is tighten up the market, right? You're going to really stop people making any moves. And we've seen that play out all the way back to 2022 as the number of listings will dry up. And and so what's your sort of take on these numbers, Pete? Is it something to be worried about, or is it, just part of the process where some months are going to surprise us, and don't read too much into the data?
Yeah, I think actually if you look at market pricing, there's a pretty good chance that the RBA does actually hike in August now. So I think it's 6th of August from memory when they have the next announcement. I think the meeting's 5th and 6th. But it will all depend on the quarterly inflation figures from July. So if you're not familiar, it was about 2 years ago, I think September 2022, Australia saw the introduction of a monthly inflation gauge. Previously, we just had quarterly figures that weren't considered maybe timely enough. So it's a new gauge. It doesn't actually cover the full inflation basket. So commentators regularly caution about mapping these monthly figures across to the official quarterly data. But of course, everyone just does it anyway because that's the nature of it. You know, you put numbers out there, everybody's all over it. I think, yes, I mean, the headline figures will come down over the next 4 months. So largely as a result of the year-on-year figures dropping off from a year ago. But the trimmed mean figures, those are kind of the core inflation figures, do look to be quite sticky. I think when you look at it, what's different about Australia? Well, our interest rates haven't gone as high as the UK or New Zealand or the US, so that's one thing. I think, though, when you look at the component parts, well, fuel prices have been pretty punchy. That's not unique to Australia, but electricity prices, massive increases over the year. And now there's government subsidies that have sort of offset that to some degree, but some of those are rolling off now. But from 1 July, the government's obviously going into a whole range of new cost of living subsidies to try and push down headline inflation again. But what the RBA really wants to see is the real core or underlying inflation figures getting back down to that 2 to 3% range. The other thing is rents. Rents, there's always a lag between what's happening at the coalface and what gets reported in the inflation data. So the asking rents seem to have actually plateaued and may even be cooling now in the middle of the year. Students have kind of gone home, at least for this part of the measurement period. But the sort of the inflation figures actually represent actual rents, and they tend to lag behind somewhat. So yeah, rents are up very significantly over the past year, and that's even in spite of government subsidies. And then there's a lot of services inflation anyway. There's home building costs have been high, insurance costs have been crazy. So yeah, some of that stuff, well, it is what it is, and I'm not sure how much another rate hike will actually help, except, yeah, I guess it just sort of helps to break the economy a bit more. I think, as you said, from a housing market point of view, what does it do? It just pushes building approvals even lower, pushes the supply response out by another 6 months. So yeah, it probably just tightens up the market further, and it will reduce borrowing capacities. Actually, on that point, Chris, did you see there was also a speech from John Lonsdale at APRA at the banking conference this week, discussing whether maybe the banking industry has become too risk averse and basically cutting off access to credit unnecessarily, which is something we've basically been talking about for the last year or so.
Oh, I don't think the banks are cutting off any credit. They're pretty hungry to lend right now. You're not going to get any ridiculous credit decisions and really hard to get loans through the banks. You know, what's just naturally slowing down bank lending is just affordability and people's ability to borrow. And there's also a huge amount of pent-up demand in what I call opportunistic upgraders. I can think of, more than 5 clients, that are looking to upgrade from a smaller house to a bigger house. And that gap's actually a little bit smaller at the moment, but they don't want to sell first. They absolutely do not want to, because they don't want to play in the rental market, and they all want to try to buy on a longer settlement, and they're comfortable to sell on a shorter settlement. Just given that they know there's a lack of listings in what they've currently got, and those prices are staying pretty good, right? If they've got a semi-decent house rather than a busy road or a dark place or something. So they've got a decent asset, but they want a bigger house, like a forever home. And I think that's really what's slowing down, obviously, credit growth. It's not because the banks don't want to lend it. I think it's a pretty cheap shot if that's what he was suggesting. If they really want to help the banks, they cut the serviceability buffer, because servicing at over 9%, and if another rate increase happens, you're talking maybe a close to 9.5% rates. When rates have already gone up, let's call it 4+%. I think that's the thing that's really slowing things down. Pete, you might not know this. It's going to put you on the spot, but solar take up in Australia, right? It's 30, 40% or even higher in some states, right? Like if electricity is going through the roof, is that factored into when they look at CPI? Like, because if you're not really paying electricity because you've got solar, is how does that all play into it?
Yeah, so consumer prices is measuring what consumers are actually paying, but then it is done effectively on a sample basis. And so, yes, some of that might not be getting picked up. Because, this is a very long-running debate about how we measure inflation. And a lot of people have said for a long time that the inflation figures understate the reality for a whole range of reasons. Consumer preferences change over time, and this is one example. But then you get things like changes in quality, which might be for the better for things like sort of electronic goods or televisions and things like that. How do you account for that? Also, shrinkflation. And it does seem to be that the cost of the essential services tends to go up a lot more. Yeah, I think this is a huge subject at the moment. I think it's actually going to be the key election issue, probably by May 2025. The coalition's going to go hard on pushing for nuclear energy. The Labour Party is all in on renewables, which is solar and wind farms and so on. So, yes, I think for people who aren't on solar, there's no question that there's been a significant decrease in power prices, even in spite of the cost of living subsidies. How well you're picking up people with solar panels charging their Teslas, I don't actually know how well that would be picked up. I guess it's probably not the bulk of the consumer spending, and therefore it's only a limited part. But that's, probably a question for somebody who's right in the weeds of that data. But I guess most people have seen their power bills go up, which is interesting because it was actually an election pledge, wasn't it? If you think back to the previous election, the government would bring down power prices and energy prices over time with renewables, but so far they've only gone, let's say, the other way. So, I guess the coalition has spotted an opportunity to position themselves differently by promoting the idea of nuclear reactors around the country. So, pretty interesting. So we should probably have a look at the 3 other news stories of the week, if I can get my mic in the right place. So firstly, David Pocock has said, should housing be a human right? Which on the face of it sounds like a simple question, but there's a bit more to it, I guess, when you get into the details. Secondly, a story on macro business. Housing targets are a fantasy, certainly way behind the curve so far through this government term. And then thirdly, buying homes is becoming a multi-generational affair. That was some analysis by your friends at Jarden. So let's start with this David Pocock story. So pretty interesting. He's sort of made a proposal that affordable housing should become a human right. So the bill would require current and future governments to develop and implement and then maintain a 10-year national housing and homelessness plan in line with a range of newly legislated objectives, which would include improving housing supply, affordability, and specifically ending homelessness to make sure that everyone in Australia has an adequate home. I was just sort of chatting through to a couple of people before we started recording about this, because on the face of it, who would disagree? Affordable housing should be a human right. But then you get into the sort of definitions of this stuff and then legal issues. Now, I've studied corporate law, but I'm by no means an expert in political or constitutional law or legislation in that regard. So, it's a great idea in theory, but in practice, what are the definitions? Adequate for whom? Based on, what constitutes affordable? These are all sort of much trickier questions. When you look around the traps, the United Nations has talked about the right to housing or the right to shelter. So a number of countries actually have similar things in their constitution. South Africa, I noticed when I was Googling around, the constitution says everyone should have the right to access adequate housing. But if you've ever been to South Africa, you'd know millions of people still live in shacks. In the US, most states don't grant the right to shelter, except in Massachusetts, where there is families have the right to shelter. And then other countries like Nigeria have the right to housing. So every citizen has the right to acquire housing and not to have it compulsorily acquired. So there's so many different variations on this. I think the key thing from my perspective, Chris, I've rambled on too long, is that when you look at rent to income ratios in Australia, if you go back over, let's say, 30 years, most people are just paying the same share of their income that they were spending on rent all the way back to 1994 across 80% of income earners. But it's in that bottom income quintile where people are paying more. So there's definitely an issue. Homelessness for a wealthy country like Australia, that really should be tackled, and I don't think anybody would disagree with that. So yeah, governments have kind of failed, I think, on the social housing aspect. Tackling homelessness is definitely key. But I think the one thing nobody would want to see a rerun of is something like the Housing Australia Future Fund, where there's some money put aside, it gets invested for 5 or 10 years' time, and and nothing actually happens. I think if this is going to go ahead, people would want to see real tangible outcomes and soon.
Yeah, I think you've sort of wrapped it up there at the end. Some of the points I was going to talk about. I think ultimately, if you ever made it a right for every Australian to have access to housing, then the government's going to have to provide a lot of housing, right? To suit certain parts of the market that mum and dads and corporations don't want to play in, right? Unless they can make a profit. So the government's either going to have to build it themselves, or do subsidies or incentives, or make it more affordable for developers and investors to play in this space. You've looked at NRAS, you've looked at all these sort of government schemes over time. So, investors can either produce that housing, or corporations. And I think, you'd have to encourage, yes, the Future Fund, but superannuation. I mean, Australian Super's doing a big deal with Assemble, and that's sort of like a rent to, a rent, and then you end up buying it after a certain amount of years. It sort of gives you ability to buy while you're, building up your deposit. And so I do think that's the way we're heading. I mean, if we are moving into more of a rental society, and I do think that's also where we're heading as well, not that I agree with it, but then the government's going to have to play a big part in this. And I just don't think they've got the appetite or the means, or are willing to take less revenue and actually solve these problems. They've always pushed it back to the mum and dad investors, but then they do things that are anti them, like you can see in Victoria right now. And even the attack on negative gearing, that might slow investors down, but that's ultimately going to slow rental accommodation down. So, and this is what's causing our rental crisis right now, is investors bailing out of the market, and not enough investors are coming back in. So it's a big question. And I just don't think the government would have any guts to do this, because it would put too much responsibility on them. And they like to play out of the property market and leave it unregulated and let the market do the talking. Because to be clear, they don't really care about high house prices, right? Like, that creates the wealth effect. What it shows one of the richest countries in the world per capita, because of our housing market, right? Our vast majority of our wealth is due to our residential property market. And so, yes, they care about winning elections, and if they can win elections by making tweaks to housing policy, but are they really willing to take ownership of everyone should have the right to own housing? And I don't think they're going to ever be that brave.
It's a pretty big, and bold statement and objective, and let's see how it plays out. I guess I think like a lot of these things, it sounds good on paper, but it's how it works in practice that really matters. David Pocock is there shaking up. I don't agree with everything he's proposed in the housing market, but he's I like him as an independent thinker and somebody who's actually trying to go into politics to make a difference, which Lord knows there's not enough of those types of people around these days. So let's take a look at this second story. Housing targets are a fantasy. So that was a piece in Macro Business, and also REA Group put out some good analysis through Eleanor Cray. So Macro Business said Albanese government's target of building 1.2 million homes over 5 years, or 240,000 homes per year, has zero chance of being achieved. I think everyone agrees on that. To achieve the target, Australia would need to build 20,000 homes more than the record high 220,000 seen in 2017, and maintain this pace for 5 consecutive years. So what we've seen is, basically the government just repeatedly making new announcements, and the Victorian government notably said they'll build 2 million homes by 2051, to keep up with the state's rapid population growth, which is predicted to hit 11.2 million people by 2056. So Leif van Onselen said, to meet the target, Victoria would need to build 71,400 homes for 28 consecutive years, a level of construction that has never been achieved before. I think there's been some approvals of high-rise towers and so on, but I guess what Leif goes on to extrapolate is really this is simply an announcement that would completely change the face of Melbourne into a high-rise city over the next 20, 30 years. So, yeah, look, they're massive numbers. They're not being achieved. I think it's interesting to take a look at what is going to trigger the supply. And, REA Group through Eleanor Cray said, there's a few challenges. We've talked about some of them at the moment. Development finance is tight. First home buyer borrowing capacity is tight. So the conditions for pre-sales for medium density apartments are terrible at the moment. But interesting analysis that they put out here says the discrepancy in price between existing and new properties is a major challenge now for the development of both houses and units. Basically, that gap is too big. So the greater price inflation for building a new home has actually made it much more preferable for people to buy established dwellings. With one exception, it looks like Perth, which has been the strongest housing market over the past year or two, the picture is a bit different there, and it does look like on that basis we're starting to see detached housing supply around the regions and the suburbs of Perth starting to pick up. But for the rest of the country, it's going to take higher prices to actually build supply online. Is that in line with what you're thinking as well?
It's a very good analysis, right? I'm looking at it here now, and I think that's a really interesting point to show that, yes, we would love to build more houses and build 1.2, but as a person looking to buy them, A, they can't get the funding for it because borrowing capacity is really tight, but B, do they really want to? If they were offered a new house at 1.2 million, but they could buy an existing house at 1 million, would they go for that? With all the issues around builder insolvencies and the risk, do they really want something new? Or and potentially with the established, can they get themselves a bit more land? I reflect on a client who came to me a month or two ago, and they were sort of outgrowing their place, and they were traveling a little bit to take their kids to school. And I spoke to them years ago before that, and they weren't sure where the kids were going to go to school. And this was in sort of the northwest region of Sydney. And all of a sudden, they've dropped the kids off at school one day and hated the drive there, and saw some new townhouses across the road. And they said, "Oh, look, it's just like a walk to walk the kids to school." And so the pain of the commute was obviously taking the kids to school. Said, "Oh, let's just get this one right opposite the school because that'll reduce that pain." But when I quickly did some analysis, they were roughly going to pay $1 million for this tiny townhouse on some ridiculously small block. I think it was like 150 or something. It was tiny. And a 1 minute search could show for the same amount of money, maybe $100,000 more, they could get themselves a 500-600 square meter block, an older house on a quiet street. And so you just got to look at this at fundamentals. A very average new build townhouse on a busier road on a tiny block, the cost to build that was not far off what you could get an established house on a big block. It wouldn't have been a renovated place, but they could renovate it over time. And so I think that's going to be the real challenge here, is that, just developers can't make the numbers stack up, and buyers will just go for the more established stock, which is until they can find a better option with the new. And so either prices have to go up on established, or the cost of new builds need to drop. And I think that's a real challenge. When I saw on this SMH today, they want to put a light rail in Parramatta Road in Sydney. It makes a lot of sense. But that's sort of government spending. I don't think the government are going to fund that, to be honest. But, any type of infrastructure spending and, industrial and commercial building and all this sort of stuff, this is taking our capacity away from what we could be using for residential and increasing the labour. Plus, you've got the cutbacks to migration. And, so I think if our labour costs stay high, plus the cost of living crisis forcing them to also ask for wage increases, and material haven't really fallen. I mean, Charter Kett Kramer did I think it was them who did some research on building prices, and they've slowed down, but there's still a lot of volatility around materials, and they're unlikely to fall. So if building prices don't fall, and the only way that they're going to start to be able to sell these things is if established properties go up a lot in value, and that means price rises. So yeah, really constraining supply, I would say, coming up.
Yeah, you're not wrong. Yeah, there was actually figures out yesterday showing building costs since pre-pandemic are up 40% for houses. So, and they're not coming down. They might be slowing. I think just to wrap up on REA's analysis, challenges are being compounded by delays in planning, limited land availability, excessive bureaucratic processes. These delays are not only slowing down the building process, but adding to higher construction costs, adding to the burden of inflation in material prices and financing costs. And we already mentioned insurance, of course. I think, REA's analysis basically shows the housing supply deficit is continuing. Affordability is going to worsen as a result. And and this is even before we talk about the potential for higher interest rates, which, whether or not it even happens in August, just the fact that it's being talked about so much is not going to inspire developers to get constructing. I do think, though, there is a cycle here. Macro Monitor put out some projections, I guess, over the past week or two, and they see that by 2027, the sheer weight of demand could see 250,000 housing starts. But that's by 2025, 2026, maybe 2.5 years away before we start to see the supply response. REA's view is that rising prices would eventually unlock new supplies, but we'd probably need to see interest rates cut, lending buffers reduced, and rising prices before eventually you start to get that supply response. In the meantime, we've got very high population growth, and that's projected to continue. So we're quite a bind, I guess, in a number of different ways. The economy's slowing, interest rates are higher, inflation sticking around, and the housing supply and rental shortage just continues. So let's wrap up with this third story, Chris. Buying homes becoming a multi-generational affair. So that was some analysis by Jarden, Australia. I know you're good friends with the guys over there. Carlos, your buddy Carlos Cacho said, it looks like on average, first-time buyers are receiving $92,000 of assistance from parents, and about 3/4 of first-time buyers are benefiting from the bank of mum and dad. I remember when these figures were first sort of thrown around by Martin North at DFA about 14 years ago, and the figure back then was about a quarter of that, about 23,000 or so. So look, we're seeing it loads of people getting parents to either buy for them outright or assist them with deposits. So it does seem to be an ongoing issue. And now we're increasingly hearing talk about not just the bank of mum and dad, but also grandparents, the bank of grandma and grandpa. And I suppose all of this is really being driven, I think, by the rental shortage. I think that's what's really encouraging people to say, let's not wait until I pass away to pass on the inheritance. Let's try and help the kids now to get them out of this rental quagmire.
Yeah, absolutely. I mean, we're seeing it. You've got parents helping kids, you've got grandparents helping grandkids, you've got not just purchasing, even if they're buying their first home, but upgrading, helping them with their mortgages. And so I think that's really holding back arrears rates, right? So you might think the kid's really struggling and probably should be defaulting on their home loan, but what they're doing is they've tapped out all their resources and they're going to mum and dad and grandma to stay in the property. They know that it's in their interest to keep them in their home. And so a lot of these things when you think about first level thinking, you think, rates are going to go up. Everyone's going to be rushing to sell. A lot of property bears love to perpetuate that. You talk about DFA here and the Bank of Mum and Dad. He's done some amazing research on this just through his surveys over the years. And I think what we've seen is just the appetite to help is greater than it's ever been, purely because they actually need the help. In the past, a lot of first-time buyers would go to their family or upgraders and go, look, I can get 80% from the bank, no problems, because servicing was just so relaxed. All I need is the deposit the cash to get to 88% loan or an 80% loan, or I just need a little bit of help. But now they need a lot of help. And we're actually seeing, the kids and the parents making property moves together. I can think of a number of clients where the kids have bought with their parents, bigger places. I know some clients who have bought with brothers and sisters and friends even, where They know that pooling their resources. They've even got a client this week that they're actually doing that with their families. They're in the young family stage, and they're going to buy something with their parents for the next 5 years, and then hopefully move into state down the line. And when the parents are retiring, but yeah, they're doing something together in the short term, and so I think we're going to see that multi-generational home pooling of resources is just one of the next evolutions of our property market, I would say. And I think it makes a lot of sense when you've got, grandparents or parents getting close to, that retirement age, and them actually getting a lot of inheritance from their parents, right? And they're going, well, I don't need this. But I want to be around the grandkids. And it makes sense for them want to help, not just because they want to help their kids, but they also want to see their grandkids, and they don't want their kids to go through rental crises or have to move out of the city, etc. And so, they're also wanting to help for those reasons. And so, I think this is just going to be something to keep watching. Obviously, it's a haves and have-nots but this is the time when you're seeing structural changes that will exasperate certain things. And I think it's going to do that. Inequality is going to get much worse over this period, which we can already see. And I think it's restructuring our rental market. I've said that a number of times, that I don't think we're going to know the impact that this period had of lower investment and investors bailing out of traditional investor hotspots, I would say, and now moving to new investor hotspots, and how our rental supply shifts and how that changes the long-term demand for actually owning. It's actually going to increase the desire to own. If it's harder to rent than it was 5-10 years ago, which it absolutely will be, then that desire to own actually increases, because renting's less of an option if you want to stay in a capital city.
The intergenerational wealth transfer over the next 20 years is going to be the biggest in history. So it's clearly going to be a factor. I think income inequality in Australia isn't that bad, but wealth inequality is going to widen almost certainly, especially in a high immigration country like Australia. I'll just wrap up this story with a quote from Warren Hogan, economist, who said to the Australian Financial Review that the market is being driven by FOMO on steroids. People have the view that the housing shortage is going to last for a long time, and that will mean prices just continue to rise. Australia has never had a severe shortage like this in recent history, so this is a major market failure. The reality is there's a price tension in the housing market because rents are going up because of the shortage of rental property, which is underpinning demand from first home buyers and investors. And yes, as he wraps up to say, it's not just the bank of parents, it's the bank of grandparents, aunties, uncles, and it's playing a much bigger role than ever before. I think in fairness, Warren Hogan, I've followed his stuff over many, many years, keen golfer as well, like me. And to be fair, he was never somebody who was pushing for extended lockdowns or anything like that, because a lot of this is really payback from when Australia had closed borders and we couldn't travel even interstate for a long time, and there was all these kind of travel restrictions. And as you said, a lot of investors have bailed on the market for a range of reasons, but now we're getting the payback in the rental shortage. And as you said, normally if you took the cash rate from 0 to 4.35%, you'd have expected to see a major correction in housing prices. Any model would have told you that, and yet here we go. We've gone all the way through that hiking cycle, and prices in nominal terms are as high as they've ever been. So pretty unusual dynamics all around, but not just in the housing market. It's been the economy in general over the past 4 years. We've seen some incredible drops and then snapbacks. And I think the acid test for the rental market will be when we come around to the summer months and the university terms, and when the students are in town. And there's going to be some pressures there to be navigated because the housing supply is really just not keeping pace.
Yeah, I think for anyone listening, right, it's doing your own research. I mean, one thing I'd really encourage people to do is think about something called the turnover rate. And, if you just literally type into Google, I just quickly did it then, Eskim research, total property listings, and you can split it up between houses and apartments, right? It's just one little button you push. And if you go back, you can look at the numbers all the way back to 2010, January 2010. So we're talking, what's that, 14 years. And, you can see there that, back in 2010, I mean, there's about 11 million dwellings now, right? I mean, what are we building? A couple of 100,000 a year, Pete? So if you go back 14 years, maybe there was 9 million or 8.5 million dwellings then, right? And maybe there's a bit less, but either way, this sort of story you can really understand. So we were selling around 300,000 or total listings for properties. That's not sales, but it was around 300,000 houses on the market. But if you look at the last 3 years in particular, there's about 180,000 homes on the market at any point. And so that's a huge drop. So we've got increase in actual dwellings is much higher. Actual listings of houses available is much lower. And so the turnover rate is tightening. And what that means is we're living in our homes longer and longer, and the actual supply, the amount of ability to buy properties actually reducing every year because people are getting stuck in their homes and less able to transact. So that means if you're entering the market, you're always entering in this undersupply market, and that's happening in the buying market. Units are a bit of a different story a little bit, but because we're building a lot more of them than houses. But I think really trying to track that. And that's a structural problem that can't be solved. I mean, we saw some, even just today, I know we've got to wrap up, but I saw some an article saying that we should give downsizers free stamp duty, because that'll get them out of their home. And it's got a little bit of legs to be honest, but it's a little bit hard to digest when you think, hang on a sec, the downsizer's not downsizing because they don't want to pay stamp duty, right? So if you're thinking that's what's stopping them, well, really, when you look at their equity and their growth that they've done and their tax-free equity growth they've made over the years, should they really be worried about paying this small amount of stamp duty on buying an apartment that's cheaper than their house? And so I find it really hard to say that the greed of not wanting to spend that money should be. But if it actually encourages people to downsize, that's going to really be a great solution for creating a bit better match between people's needs and people's property. And there's a real lack. A single could be in a 4-bedroom house, but a 4-person family could be in a 2-bed apartment. So we need a reallocation of our housing. And I personally think no option is off the table if we can encourage this to happen. And if it means letting stamp duty for free on downsizers, well, I think that should be something we should consider.
Well, there's certainly no shortage of market intervention from Labour Party, both the federal level and the state level. So anything, as you say, could be on the table. And I was just looking at those listings figures. It's pretty stark, isn't it? From 2011, 380,000 dwellings for sale, and today population is much bigger, but actually it's only 250,000. So big changes and a lot less stock to pick from these days. So let's wrap it up there, Chris. If you want to get in contact with us, send us a question for us to cover in the shows as we go through the weeks ahead. Always get in contact. Links are in the show notes. So if you want to talk property strategy or property buying, give us a shout. PeteWargent.com or Pete Wargent Blogspot. And Chris, you guys are easy to track down at the Flint Group for mortgage and lending assistance. So I think that's it for this week. Thanks so much for joining. We had over 50,000 audio downloads over the past month. So growing fast. That's great to see. And Chris, thanks as always.
Thank you, Pete. Look forward to this next week, mate. Have a good weekend and happy Sunday to everyone listening. Thanks for tuning in, guys. And send your questions in. And is there any guests you'd love us to interview or anything you'd like to cover on future episodes? We're all ears. So get in touch. Thanks for being part of this. Have a good weekend, Pete, and happy Sunday.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.